Pullbacks. After a normal impulse move, the market will usually go into a pullback or retracement. In other words, after an impulse move up, the pullback will be a downward movement against that initial impulse. Pullbacks in downtrends are bounces against the preceding downward impulse move. Volume is typically lighter in pullbacks, which is to be expected since impulse moves are driven by active buying. But many of the traditional volume relationships of technical analysis are not as reliable as many people believe. Other terms for pullbacks are consolidations or consolidation patterns. However, working to overcome those challenges is worthwhile, because some of the most reliable statistical tendencies in the market are for continuation out of these formations. This chart shows an example of standard pullback patterns. In fact, judging the commitment behind pullbacks is a key component, perhaps the key component of reading the market tape. If buyers are aggressively accumulating positions, then they will not let the market come in as much on the retracements. They will step up and buy aggressively at higher prices. This will result in shallower, smaller pullbacks compared to a situation in which buyers are relatively more complacent. If buyers are more uncertain, they will demand lower prices as protection and will not be willing to bid the market aggressively higher. The end result will be deeper pullbacks, perhaps with a more complex structure. So far, all of the pullbacks examined have been simple pullbacks or consolidations, meaning that they are composed of one contra-trend movement. The trend leg ends, the pullback begins, and at the bottom of the pullback, buyers push the market to new highs. It is not always this simple. Another common pattern is the complex pullback, which is a standard pullback followed by a failed attempt to resume the original trend. When this attempt fails and rolls over, the pullback puts in a second leg against the larger trend. A complex pullback is actually a complete trend leg structure on the lower time frame, and we also commonly refer to them as two-legged pullbacks. This chart shows a schematic example of simple and complex pullbacks. Commit these patterns to memory. They are the fundamental patterns of with trend trading. It is important to understand these complex pullbacks for several reasons. First, they are common. Trend traders will make the bulk of their profits in trends that extend for several legs, and pullbacks in trends tend to alternate between simple and complex. For instance, it is extremely unusual to find a trend that has 5 large trend legs interrupted by 4 simple pullbacks. Far more common would be 5 large trend legs interrupted by 2 simple and 2 complex pullbacks. Traders cannot negotiate the market structure of extended trends successfully without a good understanding of complex pullbacks. Another reason to understand these patterns is that many traders will execute a plan that is some variation of entering into a pullback and exiting if the pullback continues to move against them. Complex pullbacks will stop these traders out of their positions as the pullback makes new counter-trend extremes on the second leg. Any successful trend trading strategy has to account for the possibility of complex pullbacks. Measured move objective. This combination of impulse/retracement/impulse pattern leads to a 3-legged structure that should be considered the standard trend structure. A rough profit target for the follow-through leg, the trend leg following the pullback, is the so-called measured move objective, which assumes that the CD leg will approximately equal the length of the AB leg. Treat this relationship as a rough guideline. All proportions and ratios work in markets simply because they express the magnitude of fluctuations that are normal for any particular market. Certainly, there are examples where markets reach this measured move objective exactly, but it is best to be prepared to be flexible. If the swing seems to be falling short, perhaps be willing to take a slightly smaller profit. If the market is driving into the measured move objective with good momentum, it may often be possible to take profit beyond the level. Do not expect markets to precisely conform to any set of ratios and relationships. Another way to use a measured move objective is as a potential entry spot. A common area where this may occur is in a complex pullback, when it makes sense to look for the second leg of the pullback to terminate in the area of the measured move objective. Last, remember that this measured move objective, if used as a price target, provides a target for only a single swing. It is entirely possible to establish a position in a trend and hold it through multiple pullbacks and multiple trend leg extensions, in which case the measured move is valid only for each of the individual swing. free pushes. The parabolic expansion into climax pattern is a dramatic but rare pattern. There are a number of other more common and subtle patterns that can also indicate climax. One of the most important of these is free pushes, which appears on a price chart as three drives to a new high or low after a somewhat extended trend. In the best examples, the third push breaks a trend line drawn across pushes 1 and 2, indicating a short-term climax on a lower time frame. The three pushes that make up this pattern are also usually spaced more closely than most of the other highs in the trend, indicating that the pace of trading activity has accelerated. For instance, if a market has been making new highs on the trend every 15 candles, the three pushes pattern might occur with highs spaced 5 candles apart. This is only a guideline, but the more frequent drives to new highs suggest a certain franticness on the part of buyers. This chart shows a classic example of this pattern. If you have not seen this pattern before, you are probably thinking that it sounds very strange. What is magical about free pushes? Why not 4 or 5? To be sure, nothing works all the time, but this pattern is reliable enough that it demands attention when it occurs. As with all other potential trend termination patterns, it may not justify a counter-trend position, but it should at least be a warning to tighten stops and perhaps to reduce exposure in the direction of the prevailing trend. At the very least, do not greatly increase risk into the next pullback, because that pullback now has a higher probability of failure. As with all patterns, you should be asking, why should this pattern exist? What makes it work? In this case, it is most likely an outgrowth of the fundamental impulse/retracement/impulse pattern that drives all trends. This chart shows a schematic of the pattern, which also breaks out the three-legged structure that might not be obvious at first glance. This is an important pattern to commit to memory. It occurs in all markets and on all time frames, and is subtle enough that many market participants miss it when it happens.